Good day, ladies and gentlemen, and welcome to Foley's Access to Capital Web Conference. At this time, all participants are in a listen-only mode. If at any point during today's conference you'd like to ask a question, please enter one on your question box in your presentation. As a reminder, this conference call is being recorded. If you should need any assistance with your audio portion of the conference, please feel free to press star and then 0 on your touchtone telephone. I would now like to turn the conference over to your host for today, Mr. Roger Strode. Sir, you may begin.
Thank you, operator. Welcome, everybody. My name is Roger Strode. I'm a partner in the National Healthcare Practice at Foley and Lardner, based out of our Chicago office. We very much appreciate you dialing in today, and we hope that the next couple hours are going to be informative and interesting to all of you. An initial matter, just some housekeeping, and I promise you this is going to be the last time that I am going to read directly from a slide, but we do have some housekeeping matters. You'll see the slide in front of you. If you need technology assistance, there's a number there to call. You would then dial *0 for audio assistance. Questions can be entered using the Q&A tab that's located on your menu bar at the top of your screen. We intend to save about 10 minutes or so to address questions at the end of the program. We would encourage you to maximize the PowerPoint to full screen usage. You've got some instructions there. You can hit F5 on your keyboard or select View from the toolbar menu and click Full Screen. To print a copy of this presentation, you click on the printer icon in the lower right-hand corner and convert the presentation to PDF, and then you would print as usual. For those of you on the line who are attorneys or have law degrees and need CLE credits, we intend to apply for CLE credit after the web conference. If you haven't supplied your CLE information upon registration, please go ahead and email it to Ellie Harris at eharris@foley.com. I thought that was pretty good for a lawyer. Let's get started. What I'd like to do today, again, my name is Roger Strode, and I am a partner in the National Healthcare Practice at Foley and Lardner. What I'd like to do very briefly is introduce to you all our panel, our distinguished panel. But first, the purpose of this web conference is that, as everybody knows, there's an ever-changing landscape in healthcare, and that landscape continues to put a significant strain on smaller hospitals and healthcare systems and their missions to provide high-quality, reasonable healthcare to the communities and the patients that they serve. And as a result, we've seen a tremendous number of affiliations of community hospitals and healthcare systems with larger systems, and outright sales of these entities to both not-for-profit organizations as well as, and most significantly, to regional and national for-profit organizations. What we'd like to do today is talk about the conversion of not-for-profit hospitals to for-profit use, and we'd like to talk about that today by utilizing a case study of a transaction that was recently completed in York, Pennsylvania, in which Memorial Health Systems Corporation in York, Pennsylvania was sold to Community Health Systems out of Nashville, Tennessee. We'll walk you through some, what we'd like to do is walk you through some of the current M&A trends around hospital sales, hospital affiliations, hospital transactions, and specifically focusing on not-for-profit to for-profit transactions. We'll then tell the Memorial Healthcare story, and we will also talk about for-profit hospital systems and hospital providers and tell a little bit of the community health system story and how community and Memorial came together. And then finally, we'll wrap it up with a discussion of some of the compelling legal issues that anybody that's thinking about a transaction out there should really consider. On my panel today happen to be a number of individuals that participated in the Memorial CHS transaction. First up will be Matt Goldreich with Kane Brothers in New York. Matt joined Kane in 1995 and is one of the longest tenured bankers of the firm. Matt provides capital markets advisory and transaction services to a lot of nationally recognized healthcare systems and community hospitals, and assists not-for-profit hospitals and healthcare systems to implement strategic partnership transactions. He develops strategic capital plans, helps them restructure their balance sheets, fund new capital projects through the issuance of debt, et cetera. Matt has represented an awfully large number of not-for-profit healthcare systems and strategic partnerships, including Memorial Health System, in this transaction. He's very active in the tax-exempt and taxable bond financing markets. And prior to joining Kane Brothers in '95, he worked at Prudential Securities in the Public Finance Department. Matt has an MBA from the University of Chicago Graduate School of Business and has a BA from the University of Rochester. We're really pleased to have Matt on the panel. Our next speaker and next panelist will be Sally Dixon. Sally is the President and Chief Executive Officer at Memorial Health Systems Corporation, now a part of Community Health System. She served in that capacity since 1995, and prior to that, Sally was the CFO at the hospital. So that was from 1981 to 1995. Before joining Memorial, Sally was with Coopers & Lybrand, now PricewaterhouseCoopers, and was a member of the firm's reimbursement consulting practice. Sally has a Bachelor of Science degree in accounting from Ithaca College, and she is a CPA. Our third panelist is Ken Hawkins. Ken is a friend of our firm and a friend of mine, and I've had the pleasure of working with Ken and across the table from Ken. He's Senior Vice President of Acquisitions and Development for Community Health Systems in Nashville, Tennessee. He has extensive experience in hospital acquisition and development and has spearheaded most, if not all, of CHS's M&A activity since joining the company. Prior to joining CHS, Ken was Vice President of Development with Paracelsus Healthcare and Corporate. He was past controller and CFO of a couple of publicly traded healthcare companies. Ken has a bachelor's degree in accounting from James Madison University and has a master's degree from Virginia Commonwealth, and he is a CPA as well. So we are thick with lawyers and CPAs on this particular panel. As I mentioned, today's agenda, we're going to talk a little bit about hospital and health system M&A trends. Then we're going to hear the Memorial Health System story. Ken will then provide us some insights and some thoughts on community health system. And then I'll finish up by talking about some of the compelling legal issues that are involved in these transactions. And I'm going to do that because this is my web conference, so you get to listen to a lawyer for the last 15 minutes or so of this presentation. And then we're going to wrap it up with questions from you, the audience, as well. What I'd like to do now is turn it over to Matt. And the way we're going to run this is we thought it would be much more interesting if we treated this much more like a panel, a moderated panel discussion. So I will act as moderator here. We hope this is conversational. We hope that you don't feel as though we're just talking at you. A number of the panelists probably will be involved in discussing some of the various points. But what I'd like to start with first is I'd like to ask Matt. Matt, if you could talk to us, the audience, in general about current hospital and health system M&A and the hospital and health system M&A market. Specifically, I think people would like to hear about why not-for-profit organizations are seeking capital partners and why a lot of not-for-profits are considering converting their assets to for-profit use. So if you could take us through that, Matt, we'd really appreciate that.
Sure, I'd be happy to. Thanks very much, Roger. And again, let me extend my welcome to everyone that is joining us today. What we've seen in the last few years have been an unprecedented number of ownership change transactions throughout the healthcare provider industry, what we call transformative transactions. The ones that get the most recognition are not-for-profit hospitals that execute asset sales to for-profit hospital management companies, similar to the Memorial Health System sale to CHS that we're going to go into in detail today. But there are all types of other strategic partnership transactions that are occurring. Two not-for-profit hospitals that have merged together. There are also a number of joint venture transactions that are occurring between not-for-profit hospitals and other not-for-profits, as well as not-for-profits and for-profits. And all this volume has occurred because of a number of factors that are occurring in the industry, some global that impact all organizations, and some much more micro to the individual hospital that's facing its future. In general, as we all know, healthcare costs have increased substantially in the last decade or so and have reached levels that are really unsustainable on a going forward basis. In particular, government payers are experiencing significant budget pressures, whether it's at the federal level or the state level, and all of that is putting pressure on reimbursement rates. The pressure on reimbursement rates is challenging all of the hospital providers to figure out how they're going to maintain their financial viability in a declining revenue environment where only a certain amount of expense reduction is feasible. As we look at it in general, we think there are two basic forces that are going on here that are driving a lot of the consolidation in the industry. The first and most obvious one is healthcare reform in the form of the Affordable Care Act. It was clear when the legislation was passed that certain parts of what was included in the Affordable Care Act was going to continue indefinitely, even if there was a change in government that would lead to not necessarily repeal, but a tweaking around the edges of certain provisions of the Affordable Care Act. It was the general conclusion of most of the hospital providers that certain provisions of the Act would continue on, and so therefore they started planning for certain issues such as revenue adjustments and the decline in reimbursement that would be expected, particularly as we head out towards 2014 and beyond. So the providers started to look at the Affordable Care Act and say, how much of it do we think is going to continue and how much do we need to incorporate into our long-term planning? That continued on with the Supreme Court's action earlier this year, which in essence validated the existence of the Affordable Care Act. At that point in time, the planning for its implementation increased. What we had initially seen is that the development of ACOs was limited prior to the Supreme Court's ruling. Since that's occurred, we've seen a much bigger commitment and volume of activity in a number of systems on the development of ACOs. And so there's being additional planning as well as capital expenditures to develop that type of a model on a going forward basis. The other thing that we're seeing, and one of the biggest kind of byproducts of healthcare reform that's impacting planning on the provider side, has been bundled payments and the recognition that bundling payments and identifying care along the spectrum, so a more vertical integration of care, is driving hospitals to think about how they're going to team with physicians as well as subacute care providers down the road to provide overall patient care and to measure quality on that and to manage the revenue that's associated with the care along that full continuum. So that is driving different types of partnerships than had existed even 3 or 4 years ago. In addition to healthcare reform, what we're also seeing are the impacts of the specific economic environment that we're now living in. And by this, the recession and the financial market disruption of 2008-2009 has dramatically altered the availability of capital to many healthcare systems. It's also driven utilization down as many elective procedures have been postponed. So this is driving a change in revenue, and it's also driving a change in access to capital. These impacts have been particularly felt by the smaller community hospitals. And so in situations where these hospitals have seen a decline in revenue and a decline in access to capital, in order for them to remain viable and competitive, they have sought partnerships in order to ensure their long-term provision of services in their communities. One way that we look overall at where the industry is going is that in general, most organizations feel that the type of overall healthcare provider that's going to thrive in the changed reimbursement environment is going to one that has annual revenues of anywhere from $2 billion to $4 billion. And so we're seeing consolidation, certainly on the not-for-profit side, but also on the for-profit side, into large centralized organizations that will have significant critical mass. And on the not-for-profit side, there are only a handful of providers that currently fit in the $2+ billion revenue range. What we think the industry is going to trend towards, the best analogy we use is the banking industry. If you look back several years, there were a number of nationally considered commercial banks. After 2008, 2009, and the financial market crisis, the number of national banks that we might all look at and name is now down to about 4 or 5. And then below that, there are a small number of regional players, and there are still some smaller local banks, but their financial position is such that, you know, they're limited in the types of services that they can provide. This is in general where we see the healthcare industry going, that in a decade, maybe 10 to 15 years, we're likely to see on the not-for-profit side, you know, probably 5 to 7 national organizations that would go along with the same 5 to 7 for-profit healthcare companies that would operate on a national basis. There will still be some regional and community hospitals. There are certainly isolated community hospitals that don't have much independent market competition where they are, so they're geographically protected, that will continue to survive. But in general, the consolidation we see is going to result in a couple of national systems that expand their scope across the country. The next page highlights the pressure on revenues and reimbursement coming from government payers. The government payers certainly dominate the market in terms of their share of reimbursement money received by the healthcare systems, and the pressures that they're under to reduce the payments to the providers is what is putting much pressure on the providers to figure out alternative sources of revenue and how to protect their revenue sources. One of the interesting things that we see coming in the future, and one of the key incentives in the Affordable Care Act, is the movement towards transparency and quality measurement on outcomes. And the outcome-driven system where information will become more readily available and consumers will be able to identify what the results are and the quality of care on providers are, is driving towards a different measurement stream that is going to result in the provision of care being measured on both a quality basis and a cost basis. We look at that as a comparison to major industrial manufacturing, which works on those same two indices. And as the healthcare industry moves towards this level of transparency and moves towards really measuring outcomes much more specifically, we see the industry, the healthcare industry, as being much more commoditized. And so that's going to create lower margins and higher volumes in order to sustain profitability. The ability to drive individual payments and generate incremental revenues will be on the non-commodity services that can be provided, or what we call the niche opportunities. Where those can be identified will enable incremental revenue to be generated. But in general, we see an increasing movement towards easily measurable, easily comparable matrices that are going to narrow the differentiation between providers. That's going to put additional pressure on operating performance as the ability to generate margins will be reduced. This slide that shows the projected reduction in revenue under the Affordable Care Act out through 2019 helps to highlight the amount of revenue that is potentially going to be removed from the system, which is, again, forcing pressure on the providers to figure out alternative, efficient ways to deliver the services. On top of that is a projection for substantial shortage of physicians out over the next 10 to 15 years. The number's been identified as, well over 150,000 physician shortage across the spectrum of the different specialties and primary care physicians. One of the more interesting things that as a result of this is that providers, hospital providers, are looking to control access to physicians in a much greater way than they have in the past. And they're looking to do that in a couple different ways. The most obvious one is through the employment of physicians, and we've seen the trend back towards hospitals and health systems looking to employ physicians, and the expense of employing physicians has increased. We see a number of systems that are heavily subsidizing practices and are willing to incur that expense, not only to direct the patient flow and the referral pattern from the physicians, but also to have those physicians on staff and committed to their specific facility. And they're willing to incur that cost in order to then get the referral benefit that comes from the other services that are utilized. The other interesting thing that we're seeing is an increased emphasis on training of physicians. Where hospitals and health systems can control the medical education or have a part in the medical education of students, they build up, in essence, brand loyalty for those students and have a greater chance of retaining the students to become either faculty or employed physicians of the provider. In that way, filling positions that they have and reducing their need to seek outside recruitment of physicians. So we're seeing an increased emphasis on the development of academic medical centers. We're seeing academic medical centers work to much harder to retain their students and to expand their educational programs. We've seen a number of hospitals, we've seen a number of universities that operated independently that are now combining together in one way or another to take a provider or an academic institution that was not considered an academic medical center, that didn't have the thorough medical education component, and combine those together. And that's not something that we had seen prior to just a couple of years ago. On the managed care side, we're also seeing the same consolidation. And what we find interesting on the managed care side is that, the obvious desire to create leverage on negotiation drives most consolidation in just about any industry, even those obviously non-healthcare. And it's no different here, that on the managed care side, the consolidation that has occurred is primarily to enhance the ability to negotiate favorable contract terms and to improve profitability. But the other interesting thing that we're seeing here is from the government side and the incentives from the government towards consolidation. On the managed care side, government oversight and regulation is run through the SEC, and in this particular case, they've been reasonably favorable towards the consolidation of the industry, feeling that the leverage that the managed care providers can exert is only going to benefit the consumer in the end in lower prices for health insurance. Ironically, on the hospital consolidation side, the regulation there is overseen by the FTC, and what we've seen in hospital markets is an FTC concern about consolidation and monopoly within the market. And I think you've all noticed a couple of situations where there were a couple of consolidations and not-for-profit mergers in certain markets that the FTC has sought to now unwind, or in other cases is expressing opposition to certain consolidations within markets. So whereas a couple of years ago we were able to see in a two-hospital market a consolidation of those two providers. That's much more difficult to occur today unless one of those providers is in essence on the verge of bankruptcy. That's about the one situation where the FTC is willing to allow consolidation in a narrow provider market. As I mentioned earlier, the ACO development has increased significantly, and you can see here that there are a number of facilities and providers who are now actively seeking to be involved in the Pioneer ACO process and to develop ACOs. I've only got a limited amount of time, so I wanted to skip over a bit of the information on the ACO and talk a little bit about capital access and capital formation, because that's really what is driving a lot of the consolidation and particularly the issues that Memorial Health System faced as a lot of other community hospitals are facing. This chart highlights the rating spectrum from S&P and differentiates standalone hospitals versus hospital systems. And I don't think it would surprise anybody to see here that the standalone hospitals typically bear lower or weaker credit ratings because of their weaker financial position relative to the AA and A systems, which are multi-hospital systems with significant financial reserves and the leverage to generate profitability. What does all this mean from a capital access perspective? And at this point in time, we focus really on the not-for-profit hospital providers. Those providers really have four main ways to access capital. The most obvious one that everyone's familiar with is the issuance of tax-exempt debt, all different kinds of tax-exempt bonds. The second means of funding capital requirements is through the generation of operating income, so operating performance that builds cash balances. The third is through philanthropy, and the last one is through asset monetization. If we look at each four of those, they're all facing constraints for many providers, and certainly for the single site hospitals or two hospital systems. Many have reached their debt capacity for the issuance of tax-exempt bonds, and the credit markets, while bearing very low interest rates currently, access to capital for the weaker financial institutions is still more challenging. The commercial banking industry, while better than it was a couple years ago, is still a tighter credit environment than it was several years ago, making access to capital for BBB credits more expensive and with tighter financial covenants. When we look at operations, operating results have been challenged, and as I've already talked about, with revenue pressure only increasing in the future, the ability to generate significant excess operating performance that can be turned into reserves and used for capital has been diminished, and it's not likely that certainly hospitals in the BBB category are going to be generating enough operating income in order to fund the significant capital needs in the future. Philanthropy exists, but typically not on a scale to fund major capital projects, and asset monetization is also available. And by this, the most common ones are the sale of parking garages or MOBs or the reference laboratory facilities. But for many providers, those do not amount to a significant enough cash receipt that could fund capital. The other dynamic here that not-for-profit hospitals are facing when you look back at the issuance of tax-exempt bonds is that historically tax-exempt bonds were used to fund major infrastructure projects, bricks and mortar expansions. The capital requirements of most healthcare systems today, while still a little bit on the bricks and mortar side, are really geared towards needs that are not easily financed with tax-exempt bonds. And by this I mean physician strategies and IT projects. Both of those are inconsistent with tax-exempt debt issuance, which requires long-lived assets that can meet the useful life test that's required for the issuance of tax-exempt bonds with long maturities. So what we have here is a mismatch of the typical and most common needs of providers with the traditional sources of the capital. Not being able to generate that capital, these providers are looking for alternative sources. And the alternative sources that they're looking for are either mergers with other larger not-for-profit hospital systems that have the access to capital through any one of the four means that I mentioned, but most typically through either reserves or debt, or looking towards a for-profit joint venture or partnership where the strategic partner would be able to bring in the capital that these hospitals cannot access on their own and would commit to providing capital. And that was a major issue for Memorial Health Systems going forward. I only have a minute or two left here without dominating the time here. So let me kind of try to conclude with a couple of things before a question from Roger. What we've seen is a number of interesting partnerships that have been created to kind of fill the need for access to capital for systems. What we're seeing that we had not seen until just a few years ago is the combination of payers and providers. We had been seeing prior to this a lot of provider-provider consolidation, which is mostly what I've talked about thus far. What we've seen in the last couple of years are payers and managed care plans that have been acquiring providers. One of the more well-known ones is the Highmark acquisition of West Penn Allegheny in Pennsylvania, and Highmark is looking to continue and expand with other acquisitions, and we have seen other managed care plans and other payers looking to access the provider network as a way to ensure patient flow and a revenue stream. We've also seen it the other way around, where providers are acquiring payers, and so it goes both ways. So, you know, the message here is that we're not seeing any one trend that is being dominated. We're seeing individual transactions born of the opportunity within that local environment. The other main thing that we have seen and that everyone has seen over the last several years, the two main partnerships with major healthcare systems, the Oak Hill partnership with Ascension Health and the Duke partnership with LifePoint. Both of these were designed around the concept of the for-profit partner having the access to capital and being able to make capital available to third-party hospitals that need capital, and teaming up with a major nationally recognized not-for-profit healthcare system that has a reputation for excellence in clinical care. And so the idea is that the not-for-profit system will provide the clinical expertise and some management expertise, and the for-profit system will bring in not only their management expertise but also access to capital. This will bring the combination of the best of each of these organizations to a third party, not necessarily in their geographic area. So it spreads particularly the not-for-profit organization's reach to a different geographic area, but also isolates financially any risk from that investment in a new entity away from the core operations of the not-for-profit system. Let me conclude here by skipping forward to where Roger started out with the volume of activity. This chart and one more that I have shows the increase in activity and kind of summarizes what we've seen over the last few years, in that the volume of transactions, both in terms of number of transactions and the volume of hospitals involved, has increased significantly in just the last few years. So you see 2010 and 2011 and the spike up in activity. You know, this coincides both with the implementation of the Affordable Care Act as well as with the financial market decline in 2008, 2009, and the economic recession. All of these have conspired together to cause consolidation among the financially successful providers, as well as a significant increase in volume of transactions involving standalone community hospitals who look at the future and say, they're not going to have the capital to compete and remain competitive in their markets. The pie chart here we find particularly interesting on the top right of the page. What most people focus on and what gets the most profile and attention are the not-for-profit partnerships with for-profit providers and the conversion to a for-profit status. But you can see here that there's a tremendous amount of activity on not-for-profit hospitals partnering either completely through a merger or through a joint venture with another not-for-profit system. And those get less publicity, but there's a high volume of these. We see a lot of transactions continuing in the future, and we see a lot of conversions to for-profit continuing because the budgetary pressures of the local communities are going to undoubtedly exert pressure on many not-for-profit hospitals to have to start paying taxes that they're not currently paying. It's possible and in fact likely in certain communities that the tax advantage status that a number of community not-for-profit hospitals have are going to gradually be whittled away as the local governments seek additional revenue sources. We think that's going to narrow the perception difference and the financial difference between hospitals seeking not-for-profit partners and for-profit partners, and that you'll increasingly see an even split in perception in terms of the advantages and disadvantages of those two different types of transactions. So, Roger, let me stop there as I went very quickly and turn this back over to you.
Hey, thanks, Matt. Matt, one question I think that people in the audience are probably interested in, and I realize it's not something that you can just give one answer for, but can you give us some sense? And I think it's probably, just so the folks in the audience know, I believe that one of the main differences between not-for-profit to not-for-profit affiliations and not-for-profit and for-profit affiliations is the fact that in not-for-profit to not-for-profit affiliations, oftentimes there is no cash that actually transacts. There's no cash that changes hands. Nobody actually buys anyone, at least in many of those transactions. Not the same in a not-for-profit to for-profit transaction. Almost in most of those instances, unless there's an awful lot of debt being taken over or assumed, there's cash that changes hands. What is the pricing like these days on these deals, and how do for-profits look at that?
Well, I think that the question of how the for-profits looked at is probably best addressed by Ken Hawkins from CHS, because he can give you a first-hand perspective on that.
Sure.
But I think you're raising a couple of interesting questions. I mean, the pricing is really dependent upon the individual market and what the opportunity is for a for-profit system to come in and build upon its existing network. One of the things that we're seeing a lot and hearing a lot from the for-profit hospital management companies is that they are looking to build networks in areas. So where they can build a base and acquire several hospitals and build a network within a certain geographic region, they're willing to pay more in those areas. And so that's different than looking at it and saying, we're interested in this one-off hospital here in this state and another one-off hospital in another state. There are a couple of for-profit companies that do that, but the higher valuations that we're seeing is where a for-profit hospital system can come in, no different than a not-for-profit, and build a competitive system where they can manage the expense of the operation and also manage patient flow among the different hospitals for different services so that they're not providing the full scope of services at every facility. In that situation, we're seeing higher valuations. I think the other thing, Roger, that you raised that is interesting is that these are two very different types of transactions that generate different outcomes. And an interesting question is, why do some transactions are they preferred to be for-profit and why are they preferred to be not-for-profit? This largely goes to board preferences. Almost every board wants to see the services that they provide continued and, in almost all cases, expanded within their community. So a commitment to the mission and providing the services in the market and ensuring that those services will continue is usually number one on the list of objectives, and I think Sally will very well be able to speak to that. The interesting thing where it changes is that for some boards, they look at it and say, we want to continue to provide the service, but we also want to receive a cash payment, and we want to fund a foundation which we'll use to provide other health care services in the community. So generating cash out of the transaction in addition to ensuring the viability of provision of services, those are the two priorities. In other situations, we've seen boards who say, we're not interested in cashing out and creating a foundation. We're interested in that implied value, the inherent value of the net worth of our system. We would prefer to see that reinvested through services, through physician acquisitions, through investment in physical plant, and we don't necessarily need to have the cash taken out of the system. It's largely the board's perspective on that issue that drives whether or not the preferred partner is another not-for-profit system or a for-profit system. And I know that's a different issue, Roger, than you raised with valuation, but it also drives the internal thinking of boards in terms of which direction do we want to go in and which type of partner do we prefer.
And that is an excellent segue. Thank you, Matt, very much for that. That's an excellent segue into our next topic, which is really to tell the Memorial Health System story. And operator, if you'll pass the slides over to Sally, I'd like to introduce Sally Dixon. Sally, I had the pleasure of representing Memorial Health Systems and Sally in connection with the transaction and the ultimate sale to Community Health Systems. Sally, first of all, thank you very much for joining us, and I think people will be very interested to hear from a CEO who is now living in a bit of a different world than she had been living in for the past 20 years or so. Sally, could you first start by kind of giving everyone a sense of Memorial Health Systems Corporation and its organization, size, beds, et cetera?
Sure. Thank you, Roger. Memorial Hospital was a one-hospital system in York, Pennsylvania, about 65 years old. Took its roots actually from a for-profit hospital that was developed by a group of osteopathic physicians in our community. It's 100 beds built, the current facility built in 1960. We have a 20-bed ER, which is a little lopsided with a 100-bed hospital, but nonetheless a 20-bed ER, which is new. An ambulatory surgery center with 4 ORs, an endoscopy center, home health and hospice, a large industrial medicine program with 2 sites, and a physician practice network that's comprised of 7 primary care offices with about 14 docs and 3 specialty offices, including OB, urology, and cardiology, that accounts for about 8 docs. At the time we were beginning this process, we were at 890 FTEs system-wide. We had been at Best Places to Work in Pennsylvania for 10 years straight. So we had a strong relationship with our associates and our physicians. We were exhibiting excellent performance against core measures. We're a teaching hospital with residencies in emergency medicine, general surgery, family practice, internal medicine, OB-GYN, and orthopedics, and have a house staff of over 50, which again makes us look a little different than most hospitals our size. Some of our key statistics, at the end of our fiscal 11, we were sitting at about 8,000 total cases. 5,400 of those were admissions and 2,600 were observations. And so we were running an average occupancy of about 65%. Our ED cases totaled 42,000, and we were looking at about 650 births. When we look at net revenue, the system in total was about $116 million, net assets of about $28 million with total assets of about $70 million. We had less than 60 days cash on hand, which was actually a better position than we had been in for many, many years. But we were finding a huge need for capital. We had spent $36 million in capital over the previous 4 years. Our patient mix was fairly healthy. Payer mix, if you look at it on a net revenue basis, 36% was Medicare, about 8% was medical assistance, about 30% from the Blues, and the rest were sorted between other commercial payers. And on a patient discharge basis, about 45% Medicare, and another 17% were medical assistance and self-pay, with about 18% from the Blues. Again, the same sort of mix that I think Matt was talking about before, heavily weighted toward government payers. From a service perspective, we looked a lot like most community hospitals. Some of the things that made us look different. We had a family birth center that was fairly active. As I mentioned, we have an outpatient endoscopy center and an ambulatory surgery center. We also had a robotic surgery program, again, unusual in a 100-bed hospital, an interventional cardiology program where we had been able to gather back about a third of the market. We have medical staff of over 250. Approximately 150 of those have admitting privileges. One fact that was troublesome to us is the fact that a third of our medical staff has been on staff for over 20 years, and an even larger percentage was 55 plus. When I look at the overall market, we sit about 60 miles north of Baltimore, and our service area is primarily York County and some of northern Maryland. Within 30-mile radius of our hospital, there are 7 acute care hospitals, and in our primary and secondary market area, there are 3, the largest of which is a system that has over 650 beds and $1 billion in revenue. Our overall county is characterized as stable, a diverse economy. Our unemployment rate runs slightly below the national average, so we've been in the 7 to 8 range, kind of bouncing around. And we're fortunate, being in Pennsylvania, that we sit in a county that has had substantial population growth of over 13% over the last decade, and is projected to have a 10% growth over the coming decade. The largest concentration of population sits in the 35 to 65-year range, and the fastest growing part of our population is 55 plus. Our primary and secondary market area accounts for about 250,000 in population, and greater York County and our extended market area is about 400,000. That's kind of a brief look at who we were and where we sat from a competitive perspective when we began this journey.
Okay. Well, Sally, with that in mind, I think what we would find interesting is if you could talk to us a little bit about the circumstances that led up to the decision of the board, you and the board, to find some sort of strategic partnership out there. I realize from my history with you that there wasn't this immediate leap to, oh, we need to sell this hospital. You guys started looking quite a while ago at what do we need to do for this hospital. So if you could talk to us a little bit about what led up to that decision and the kinds of things you thought about that led you to where you are today.
Sure. As most nonprofit hospitals, we had one full-day planning retreat where we talked about what it was going to take for us to be a sustainable choice in our community. And that really was a launching pad for developing kind of a three-pronged approach to what we thought it was going to take to create sustainable choice in the healthcare market in York County, given the large competitor that we had. We believed that a new facility was absolutely critical. The facility that we are currently in, as I mentioned, was built in the 1960s. And was built at a time when about 15% of our revenue came from outpatient services, and the remainder came from inpatient services. The design of the facility doesn't really allow for the way healthcare is delivered today. You know, we're probably 60% outpatient and 40% inpatient as we sit today. And the dynamics of the facility and the ability to incorporate certain technology has just become extremely difficult. We also sit on a site that is in the floodplain and has created some problems for us from an expansion on our current site. So the board believed that the right thing to do was to build a new facility and, in fact, look for a new campus. Second prong of that was to expand certain service lines and build certain new service lines. We essentially had no oncology service line. and cardiology was very limited. We wanted to expand the OB and ortho service lines. We felt that those were going to be important and critical to the success of any community hospital. And along the third line was to build medical staff, and the medical staff development plan needed to take into account anticipated replacements that were going to be required. As I mentioned, our medical staff, while very loyal, was also aging quite rapidly. And we also believed that we needed to grow our primary care base as the population was growing in York County and meet the needs of the community, and also build a subspecialty base. We were very largely dependent on primary care individuals providing certain services, kind of an old model where internal medicine folks, physicians were providing a lot of what we would typically today think of as subspecialty, cardiology, gastroenterology, pulmonology, and those sorts of things. So it was that need to create a stable future to maintain choice in our community that really drove the board forward. As we started to look at things that were changing in our environment, we started to question whether or not that was something we could do independently. And we started looking at a lot of the things that Matt mentioned with respect to, you know, changes in the environment and changes in regulatory environment and the like. But our board actually said that their first preference was to maintain the local control, if they could still maintain choice in the community. So our first endeavor really looked at the ability to finance that new facility and some of the additional investment that we needed in physicians through a number of different ways. A renegotiation of contracts, we evaluated HUD financing, and really kind of at the beginning of this process felt like the HUD financing might just work. It left us short on the one side that Matt talked about, where, you know, you need to be able to finance the investment in physician practices, and that was going to be a challenge for us, as was some of the IT and technology. But we thought there was a chance at making that happen. And then I would say three major things happened in our market that drove us back to this process of looking at independence again. One, a new specialty hospital opened, 30-bed orthopedic hospital, and in our surgical volume, about 60% of our surgical volume was orthopedic. So that in and of itself obviously created financial strains from an operational standpoint. I think they were one of the last hospitals to get in under the wire, under the grandfather clause, and so it was kind of touch and go as to whether or not that would actually open, but it did ultimately, and it did impact our surgical volumes quite substantially. Second was the economic downturn and the flattening off of volumes. As most people know, as you grow, there's a lot more latitude in financial performance if you've got increasing volumes continually, and so you can support some of the increasing costs far easier than when the volume flattens out. Last was we had undertaken the beginning of the building of our cardiovascular program, and we were moving toward an interventional platform, which we did not have. And the group of docs who participated at Memorial, cardiologists, and also participated at our largest competitor, pulled out at the 11th hour. And so we were faced with having to build a cardiology physician practice, and really hadn't allocated the dollars to be able to do that from a physician practice investment perspective, because we thought we had that covered with an independent group of physicians. Understanding that that was going to be critical to us, we continued to move forward, but we also started to look at where we were going from a financial perspective. We were seeing declining margins, like I said, flattening growth. Clearly, the regulatory environment and the changes there were of concern to us. How would we adapt as a very small independent system? We continued to experience less than level playing grounds in dealing with the payers and contracting with payers. And we could no longer access any capital, be it from a facility perspective and bricks and mortar, nor for the IT, technology, and physician practice investments that we were looking for. So Certainly access to capital was huge. Continued downward pressure on government reimbursements, as has been mentioned before, all brought us to the point of thinking that bigger probably would be better for us. It didn't matter what we seemed to touch, whether we were looking at how we addressed regulatory or how we addressed our lack of purchasing power, supplies, even human resources. Being unable to offer physicians a look at what the future would look like in a stable environment started to become a problem in recruitment. So being able to ascertain that expertise through purchasing power again drove us to that. We thought bigger would probably be better. So that's kind of the layout of how we got to where we thought we really needed to do something.
All right. Real quickly, Ken and then Matt, is the Memorial experience similar to what you see, Ken, in the various markets in which CHS seeks partners?
Yes, so we see all kinds of different versions of that, but it ultimately is about the same. It boils down to capital needed to expand and grow your market and have enough capital to make your facilities to be comparable to your competition and things like that.
And Matt, could you weigh in on a little bit on the physician piece of this, and if you see that in a lot of the hospitals that you guys help?
Yeah, I mean, the physician component has become an increasingly important and dominant driver of these types of transactions. The cost required to recruit and maintain physicians has increased substantially, putting a stress on hospital operations and also challenging the need for outright capital to acquire practices and to spend money on recruiting. These are dollars that, hospitals similar to Memorial Health System just do not have. And as I mentioned earlier, they can't be financed easily within a tax-exempt bond financing, certainly not on a standalone basis, and it makes it difficult when you combine it in with bricks and mortar type financings. So that's become a driver for the smaller community hospitals to seek partners because they can't remain competitive on the physician side without having an outside source of capital in order to attract and retain physicians.
Great, thank you. And Sally, I realize that it probably would have been easy for you guys to simply walk down the street to your biggest competitor, who probably would have been very happy to take the keys and take them and sort of take the market over. And your board decided not to do that. Over the next 10 minutes or so, would you mind walking us through how you and your board reviewed strategic alternatives, and then the process of picking a partner like CHS, what you went through in the process, and kind of what the deal makers or the deal breakers were? The next couple of slides.
Yes, I will attempt to do that.
Thank you.
First off, I think what was one of the things that was critical to our process, and one of the reasons why our process was ultimately successful in our mind, was that we did take the time to thoroughly evaluate and validate our decision with some outside help. We had some financial pro formas done that validated the projections that we were doing internally. We really pounded on our decision to make sure that we were making the right decision to decide to seek a partner of some sort. And I can't stress that enough. Bringing everybody to the same page, I think, made the entire process run smoother. So I would highly recommend that for anybody that undertakes this. We did spend a great deal of time evaluating the pros and cons of every potential structure. We looked at almost everything from joint ventures, investment by physicians, a complete purchase and lease back of assets and building of the new facility, you name it, all the way to acquisition. And really believe that we shouldn't let the deal structure drive our decisions, but what we should do is to take the time to address what we thought our objectives were in this entire process. And so we did that fairly early on. We decided that it was important for us to understand why would we be looking at any sort of change in ownership or structure at all. And so we took the time to hammer that out with the board and the senior leadership and with our associates and sharing it with them. primarily, when we look at the objectives and what we were trying to achieve, we believed that we had set out the right vision for how to be successful in our community, and what we needed was the capital to be able to do that. So we were looking for a partner who was willing to build that new facility for us, who was willing to invest in the technology that would get us to where we needed to be, particularly on the IT side. An entity that had the vision of growing the physician staff at Memorial, and in particular a company that had the ability to invest those soft dollars, if you will, in physician practices. They don't show up as investments on anybody's balance sheet, but they clearly are investments in the future when you're talking about building something large like a cardiology practice, or even something smaller like a primary care practitioner. So that was critically important to us. We decided that we wanted to make sure that we only selected a partner that would enhance our reputation, and we were very careful to ensure that we didn't include folks on our potential list that wouldn't do that. We thought that it was very important to maintain the connection to the community, and by that I mean the involvement that we had with our community, both in dollars contributed to them in support of many other nonprofits, smaller nonprofits, and the people that are involved in those entities, as well as our charity care programs. I mentioned we're a teaching hospital, and we date back all the way to the beginning of the hospital with those teaching programs. That was important to us, as was the overall, I don't want to say protection, but the overall future of our associates. It got down to the fact that when we looked at our list, unlike some entities, somebody said, well, do we need to address the for-profit or not-for-profit issue? And for us, we really didn't feel like we needed to. It didn't matter to us what the tax status of the partner was that we found, as long as we met these objectives and criteria and found someone who had the financial wherewithal and stability and culture to get it done the way we would do it. So those were the important criteria for us, certainly. Excuse me. So after establishing those objectives, it became very clear to us that we would really be narrowing our focus too much if we relied on only our own expertise in identifying potential partners. And that's when we went to the marketplace to find an investment banking firm that would be able to help us. We felt it was important to have a national presence. We wanted an entity that was truly connected with what was going on in the marketplace. But we also wanted an organization that was doing deals that looked like us. So the long and the short of that was we found out in Cain Brothers. Their boutique feel and a cultural fit with us, as well as their knowledge of the marketplace, really made it almost a no-brainer for us in selecting them to help us decide where to go with this, and to select the partners, and to shake the market up so that we got the best potential meeting of our objectives. We only had a few deal killers. One was, and I can't remember who mentioned it, but the closing of acute care services. Our board was very much about choice in our community, and it was pretty important to us that our services not only be maintained but expanded. And if we had a partner who would compromise our reputation, as I mentioned, or someone who really lacked the financial staying power to commit to the investment that we felt like we needed. All along the way, the ability to maintain an opportunity for choice in our community, I think, probably would have been the only other potential deal killer, is if we couldn't maintain choice. And that goes with the closing of the acute care services, for sure. That's, in essence, how we proceeded through the process. We went through the must-haves. We looked at all of the potential partners. We developed the RFP and ultimately made the selection of community health systems. Community health systems, to us, met the objectives that we were looking at trying to achieve. that clearly understood our vision, in our opinion, and clearly supported the vision, and had the same passion for delivering care at the local level that we felt was pretty important to us. And, we felt like the resources that we would gather from them would, in essence, push our strategic vision forward faster than we could ever do it on our own. And we ultimately ended up doing an asset acquisition transaction with them.
Oh, thank you, Sally. And I think one thing to point out to everybody in the audience, one of the things we'll be talking about in a few minutes in the legal issues are both board duties as well as the review of these transactions by state attorneys general. And what you'll find for those of you that are preparing for this is that in many cases, not only does a very thoughtful, unbiased, skeptical process by the board and by management go a long ways to fulfilling your board duties, but it also will go a very long ways to assuaging the concerns of the local attorneys general or the state attorneys general, who is responsible for making sure that charitable assets are protected and properly used and especially in these sorts of conversion transactions. And it is one thing to note that the transaction done here was done as an asset deal. We'll talk a little bit about that during the legal piece as well. Sally, Ed, thank you very much. And what I'd like to do now is swing it over to Ken Hawkins. As I mentioned before, Ken is the Senior Vice President of Mergers and Acquisitions and Development for Community Health Systems. And Ken will tell you a little bit about Community. I've worked with Ken as my client, and I've also worked across the table from Ken. And the folks at Community Health Systems are very, very sophisticated in their approach to M&A on the hospital side. And Ken was very deeply involved in this transaction from the beginning to the very end of the transaction. So, Ken, what I'd like to do first is if you could open it up for us and give us a sense of the size and scope of Community Health Systems. And then after you've done that, if you wouldn't mind profiling for the audience the types of hospitals and health systems that you find most attractive, that your company looks for, why you look for them, and sort of contrast that to Memorial and what you found attractive about the Memorial situation.
Sure, Roger, thanks. A little bit about Community Health Systems. I've been here 16 years, so I've seen it grown from about 35 hospitals to our current level of hospitals is 135 hospitals in 29 states. We're one of the largest operators of acute care hospitals in the country. We were founded in 1985, and we have about 20,000 licensed beds now. We have a very good website if anybody wants to take a look at us at chs.net. Like the parties have been telling you, we all of a sudden now own a lot of physician practices. Now we have 3,000 employed physicians in our company. We've also been very active in imaging centers, surgery centers, home care, and various hospice agencies. To give you a little sense of some of the statistical information about our company, we have this is 2011. We have 16,000 medical staff members, 90,000 plus employees, 675,000 admissions in 2011, 2.7 million emergency room visits, 16 million outpatient registrations, and about $12 billion in net operating revenue. So that gives you a little sense of the size of our company. One of the things that we are starting to do now is try to focus our acquisitions on our existing states and markets. Like Matt was talking about earlier, we'd like to get sort of a cluster of hospitals in an area and kind of form an integrated delivery system or an ACO or whatever it's going to look like here coming up. But what we look for in our markets is growing markets somewhere between 20 and 400,000 people, has a good employer base. The employment's not based on one single employer. Potential for service expansion. Like York has a very good unemployment rate. Like York had a favorable demographic and economic trends. I mean, it actually had growth going forward. A lot of jobs there. But one of the most important things is has a financial performance that will benefit from our management skills. And a lot of that's around potential for service expansion and the type of programs that we bring to the hospital. And York fit right into all of that. It was a very, very nice community. Does that answer your question, Roger?
Yes, it does. Yes, it does. Very well, Ken. And you may want to move your slide down.
Okay.
Ken, when you go into a market like Memorial's market or any other market, and you obviously face, I would imagine it's getting easier for you guys as you have grown and has, companies like yours and some of your competitors have become much more prevalent in the markets. You still probably every once in a while have to overcome, I would assume, this burden or at least this hump of for-profit medicine versus not-for-profit medicine. Sally clearly said that in their case it wasn't even an issue. They didn't really care what the tax status was. But I would assume you have to overcome that from time to time. Other than money, and I would like to talk in a minute about how you price things, can you talk to us a little bit about what companies like yours and yours specifically bring to hospitals that quite possibly they're not going to get from the local not-for-profit partner that they could have picked, maybe a competitor, for example?
Yeah, I'll begin with one of our philosophies is when we go into a community is we're all about growing the hospital. That's how we grow our company, is grow the hospital. And a lot of times, a lot of these not-for-profits, when they decide to merge or be acquired by the local larger facility in the nearby town, that doesn't tend to happen for them. And what we try to do is grow that facility in order to provide all the services in that community, which in some cases would be competitive with the other hospital in the other town. So that's one of the philosophies we look at. So that's one of the things. And I always tell everybody when you're talking about what's the difference between a for-profit and not-for-profit, other than the tax exemption, is if a well-run for-profit and a well-run not-for-profit would be exactly the same, because they all got to do the right things, or they'll never proceed, and people will go other places for their health care services. So, but what we bring to the table is our ability to access capital. That's one of the big things. Invest in the facilities, and invest in equipment, and, of course, physician recruitment, which I'll talk about a little bit more on the next slide. But we're very good at improving hospital operations. You'll see that on the next slide, too. And we also put in place a local community board, and all the folks on the board are all from the community. The only person from CHS on these boards is the CEO of the hospital, and that person lives in that community. So we also, we pay local taxes. We cause a local foundation to be established, which we have no control over. It's all being run by local folks. And they go out and invest in other type of healthcare things in the community. We promote professional growth for employees, economic growth in the community. Every doctor you bring into the community, and I'll show you in a minute how many we bring in yearly, has a multiplier in those communities. It's like a little business. So that's the type of things we bring to the community. Another thing I always bring up in the not-for-profit versus for-profit is, they'll always say, well, do you pay dividends? Well, our company has chosen not to pay dividends and rather invest all that back into the company. So we generate probably a little bit over $1.2 billion in cash a year. And this year we're going to spend almost $850 million in just capital into our hospitals. And the rest goes to pay debt and all those type of things. So I just thought that that's a good thing to let you know that, so I can't see much difference.
Ken, can you, with respect to the community board, I didn't prepare you for this, so it's a little unfair for me to ask you, but I'm going to ask you anyway.
Sure.
You have the community boards. Can you talk to us about the credence you give to those boards when those boards make decisions and advise you? Because clearly, Community Health Systems is the owner of the hospital at that point. The board itself doesn't have the ability to hire or fire people. they're in an advisory capacity, but can you talk a little bit about how you work with these boards and the kind of authority and or at least advisory power they have with respect to your organization?
Well, let me say firstly the makeup. Usually we have maybe usually it's about 10, 12 people. Usually 4 to 5 of them are physicians. That's pretty spread over the medical staff, and the rest are all local business people. And we relieve the fiduciary responsibility of the board. They don't have to worry about having enough money to pay payroll and that type of thing. But what we like our boards to do is be very active in the development of strategic plans for the hospital, the vision, mission, and value statements. Participate in development and review of operating capital budgets. We have the ultimate authority on that. We want them to conduct evaluation and selection of the CEO. In other words, if they don't like that CEO, that person's not doing a good job, they can actually cause that CEO to be moved. Of course, they do all the other things like grant medical staff privileges, joint commission accreditation and compliance. We get them very active in physician recruitment efforts. And they're basically the voice of the community, so we want to hear what they have to say. So our boards are very active.
Okay, and are you able to keep them, in quotes, engaged?
Absolutely. Our local management team does a very good job of that, and we typically, in most cases, when we take over a hospital like York, we like to keep a fair amount of the same board members because they have a history, they know all the things that's been going on, and that type of thing. So we have a lot of that. We use a lot of the same board members going forward.
Okay. Can you talk a little bit, Ken, before we move to the next slide? Can you talk a little bit about pricing and how it is that you go about pricing in these markets and the things that you think about and what is important to you in terms of coming up with a price for a hospital?
Well, there's a lot of different things that I take into consideration. For York's example is the fact that they needed a new hospital, which that affects the pricing somewhat. But we look at the community. Is it strategic? If it's standalone, if it's like Matt was saying, the prices are a little bit higher when it's strategic. He's probably quoting us because I think he did the last strategic deal we did. But in any event, we look at that. I look at the other issues surrounding is there growth in the community? Can we grow the hospital? Is it a stable medical staff? And it's how much you're going to have to put in it to get it to go to the next level. And so we look at that, and then I kind of take a look at where they're at today and where we think we can be in the first year, and I do it based on some multiple of trailing or maybe a multiple of revenues. It depends on, some of it's, back of the envelope type thing. You got to kind of see what's going to work in that specific situation. I can't tell you all my secrets or I'd be in trouble with you.
Ken, I would assume that in a situation, for example, like in York, where you've committed, and one thing to point out, and I do apologize if this wasn't clear for everyone, that CHS did commit, in fact, to build a new hospital in York, and I assume that plans for that are underway. With that, when you commit to build that new facility, I assume that has an impact on the cash value that you are going to pay in exchange for the hospital.
It does, because when you build a new hospital, it brings down the rate of return on it over time, so it does affect the price.
Okay. All right. And then finally, Ken, in the last few minutes that we have here for your piece, can you talk a little bit about, I know on your next slide you have some stuff on there about the kinds of services that you bring to a hospital and your resources that you then bring to these hospitals. Can you also talk a little bit about the realities of having a for-profit partner versus a hospital having a not-for-profit partner? It's not so much burdens, but just the realities of what it's like for a hospital that has been, for a very long time, a management team that's been operated in not-for-profit solution, tax-exempt solution, moving to a for-profit, especially a publicly traded company, as a subsidiary?
I'll answer that first, and I'll go into this because I think it's kind of excuse me. In a for-profit environment or any well-run hospital environment, what we typically do, we want information quicker so we can figure out, do we need to react quicker to what's going on in the market and what's going on with operations of the hospital? Is there something that we need to get some resources out to very quickly, which you'll see our resource list here? So one of the things that Sally and her management team, I think, probably had to get used to is answering questions more quickly and analyzing things. We analyze everything because if you don't measure it, you can't fix it. So that's kind of how we look at it. So we analyze everything, so the reporting is a little more, I think, more so in our environment than probably her environment, and that type of thing. So, but if you go to these, and also you have access to more resources. If you look at this list, we built, CHS has built the company around, I've been fortunate to be here all the time when we've done this, around these core set of services that we provide to our hospitals as sort of like a consultant. And I'll pick a few out of this list to talk about because I think they were very important to the York board when we were going through the process. One of them was, the facilities management and access to capital. We have an internal group that actually will help build that hospital, or in which brings the prices down tremendously when we go to do those type of things. We don't have to go out and outsource all these different things. We have an internal group that will go out and manage that process. Physician recruiting was another big area that they were interested in. We have an in-house department that we built to handle that for our hospitals, about 35 people, and last year they recruited more than 1,800 physicians to our hospitals, and that's a huge resource for our hospitals. We are very, very strong in quality and patient safety. We develop and put together numerous tools and purchase numerous tools and programs to make sure we have highest quality and patient safety. And also another little thing that I think was important when we took in to visit one of our other hospitals, we've installed a student program in all of our hospitals, which has really been very helpful in patient satisfaction, employee and physician satisfaction scores throughout our hospital system. So that's what we bring to the table that a lot of other not-for-profits and other smaller health systems just don't have that. It didn't have that kind of base of services that we can offer the hospitals.
Thanks, Ken. That's extraordinarily helpful. What I'd like to do now, operator, if you can turn the slides over to me, is for the next 15 minutes or so, what I'd like to talk a little bit about is some of the compelling legal issues that we find in these transactions. And I think what you'll see is certain of the issues that we hit upon are issues that arose in this transaction. They're issues that I know that Ken sees, as he works very closely with counsel in these deals, that Matt sees and that Sally saw. And so I'd like to talk briefly about some of the charitable trust issues here, board duties, a little bit about how the antitrust laws impact transactions. I'll be frank with you, we didn't really have antitrust issues here. In fact, we had probably the opposite because we had a new entrant to the market. Due diligence and compliance and how important that is, and then finally some transaction document issues, some transaction issues. Probably the biggest gating item that we see, and that anybody out there that is a not-for-profit hospital, if you're considering a transaction in which your hospital may be sold to a for-profit partner, one of the things you need to think about is whether or not your state has a charitable trust doctrine or a cypre doctrine, and or whether or not there is some level of state review, which is often through the Attorney General. I would tell you that in the state of Pennsylvania, for example, there's no specific law that says the Attorney General of the state of Pennsylvania has the right to review a transaction where a not-for-profit hospital is being sold to a for-profit. Really how it works is there is a statute that requires a local court of equity, in this case called the Orphans Court, to approve the sale of a not-for-profit hospital to a for-profit or the conversion of not-for-profit assets or charitable assets to for-profit use. And the idea is to protect those tax-exempt assets and make sure that they're being marshaled correctly. And how the Attorney General bootstrapped its way into this was the Attorney General on behalf of the state would have the right in an Orphans Court proceeding to object. So what the Attorney General did was he drafted a set of protocols in which the Attorney General said, essentially, you need to come to our office first and ask us to weigh in on this transaction and approve this transaction, and if you don't, we will intervene in an Orphans Court proceeding and we will object. So essentially that's what they've done. In some states it's very clear that the Attorney General has the right to approve or disapprove transactions, and in certain states there's simply a review where the Attorney General reviews these transactions. In states where the Attorney General takes a big role in this, I highly recommend that the AG's office be contacted early in the process, because one of the things you also deal with in these situations, and Ken, I know you guys have dealt with this before in Pennsylvania, we've seen it in Ohio, Matt, you've seen it in other states, is because in certain instances these can be very high-profile transactions, the Attorney General never wants to be surprised or embarrassed by the fact that a transaction shows up in his or her office before they know about it. And you can go a long ways with these AGs by letting them know that something is coming down the pike, which is particularly apt in Pennsylvania, that something is coming down the pike and that they should expect to hear from counsel for both the acquirer and the acquiree. What is it that the AG is going to be interested in? As a general rule, and this isn't a given, but as a general rule, they're generally going to be interested in the identity of the buyer and whether or not the buyer is the type of organization that's going to preserve the mission of the selling hospital. They're also very, very interested in the process that was used to reach the ultimate decision. They don't want to see a hospital that went from immediately being a not-for-profit to saying, we're going to sell and we're going to sell to community, or we're going to sell and we're going to sell to this person. They want to know that a thoughtful process was used by the board, and as you'll see in a minute, not only does that help the board ensure that they have adequately prosecuted their fiduciary duties, but it very much helps in the process with the AG. The other thing, because most of these transactions are cash transactions, they're going to want to know that the price that's being received by the not-for-profit organization for its assets, and by the way, most of these deals are done as asset deals, and I'll explain that in a minute, whether or not that price is fair. And in this instance, sometimes it's simply the negotiation between the parties, but oftentimes the AG may want to see a fairness opinion from an investment banker. So, for example, the Cain brothers, as well as other investment bankers, give fairness opinions as to whether or not the price was fair, the terms are fair and reasonable and essentially market. Another way to do it is obviously you can seek third-party appraisals as well. The last thing they want to know is how the net transaction proceeds are going to be utilized and how they're going to be held. Often what you see in these transactions is that a not-for-profit foundation is formed, or if one is already in place, the proceeds are given to the not-for-profit foundation. And in many instances, the AG will require that foundation fund only community health care needs. Now, what health care needs are sometimes is a matter of debate with the Attorney General, but they want to know that in many cases that these funds aren't going to be used to build playgrounds or swimming pools or things of that nature, that they're being used to fund community health care needs. That goes a long ways with the AG. That then leads into a sort of a logical segue into board duties. Board members of these organizations oftentimes ultimately reach the conclusion that the hospital is better served by having a strategic financial partner, whether it's a not-for-profit partner or a for-profit partner. And in doing so, they usually are saying to themselves, we're kind of reaching maximum capacity here. We're getting to the point where the problems that are out there are above our respective pay grades. And you know, your average community hospital, oftentimes there are members on the board that are local business people, but yet they don't have the expertise to run these very complex organizations, whether they're big or small, in a very complex environment. So when boards come to us and ask us, what are we supposed to do in making this decision? Do we have to consider every offer that comes across our CEO's table? Gee, we got a call the other day from the board chair at XYZ system. Do we have to go talk to them? Do we have to do that? And once we do it, what do we have to do? Well, answer number one is, in a not-for-profit organization, it's not like a for-profit organization. You don't have to listen to every offer that comes across the table. You don't have to consider every offer that comes to you. You can decide, we don't want to do this. Once you do go down the road of deciding whether or not your organization is going to affiliate, you generally have two overriding duties, the duty of care and the duty of loyalty. What is the duty of care? What is the fiduciary duty of care? It's a duty that requires a board member to act in an informed, good faith manner when thinking about these things. You're supposed to, as the courts say, exercise the care of an ordinarily prudent person in a like position. One way that you can make sure that you have complied with your duty of care is to make sure that the board is sufficiently informed and in good faith and with honest belief takes actions that are in the best interest of the organization. And again, what the business judgment rule looks at is process. How did you come to the decision you came to? Did you look at all the alternatives? Did you seek legal counsel to talk about what the legal issues are? Did you seek an investment banker or financial advisor to talk about what the alternatives are, what the best use of cash is, what the best use of the assets are? You know, specifically, were you careful with your assets? And when you didn't know a question or an answer to a question, did you ask someone who did? This is very, very important in making sure that you complied with the business judgment rule as well as with the duty of care. And again, by making sure that you comply with that duty of care, that goes a long, long way to making sure and being able to assure the Attorney General in your state that you have, in fact, engaged in a very thoughtful process. There's also the duty of loyalty, and that means that directors and trustees are to exercise their power in good faith in the best interest of the hospital and its mission, not in his or her own mission, so not in his or her own best interest or the interest of a family member or some entity that they own. So before you start these processes, look for conflicts of interest. Most hospitals now have very sophisticated conflicts of interest policies. Look at these policies and make sure that there aren't any conflicts. Are there going to be any offers of employment from the acquirer here? You do business with the hospital, do you have an entity that does business with the hospital? You're hoping that the acquirer will do business with you, and you've had conversations about that. Avoid those things. You also have to maintain confidentiality of the board process. Talking in the community oftentimes can really hurt a deal and can hurt your hospital, so you have to make sure that your board is very, very aware of their duty of confidentiality, and sometimes this is very difficult in a small community to keep these things under wraps. I think that Sally and her board did a tremendous job of this, but there was constant reminders of the board. And all of this is particularly challenging for physician trustees, because you have to remember, in many cases, especially in smaller hospitals, physicians are going to feel very, very vulnerable in these situations. And oftentimes they will wonder what their future is going to be vis-a-vis an acquisition. And how is it that I prosecute my board obligations and watch out for myself at the same time? And some doctors are great at this, and some doctors aren't so good at this. And you have to be aware what the physician complement on your board is and what might happen with respect to those physicians down the line. And really, from a practical tip, again, focus on an informed process and make sure that the board members understand what they don't know and that they go out and they seek advice of people that they do know. So that means hiring subject matter experts like financial advisors, legal counsel, accountants, et cetera, whoever it is that you need to make sure that you know the answers to questions. Focus on the mission of the hospital and the service of the community, and in doing so, be skeptical and ask questions. Don't simply accept whatever's tossed at a board member. And then finally, ferret out conflicts early in the process. I think if you keep at least these 5 things in mind as kind of at least a partial charter, it's going to go a long ways to making sure that your board members comply with their fiduciary duties. Antitrust is these days is a big issue, and if you are in a concentrated market or a less than concentrated market, and you're going to go from a 2 to a 1 or a 3 to a 2, you need to understand that the FTC has become particularly interested in market concentration. They stopped the merger in Rockford, Illinois, the Rockford Memorial OSF transaction, because they were concerned about the market going from a 3 to a 2 in Rockford. And by the way, they were also concerned about the consolidation of the physician complement, because both OSF and Rockford employed a great number of primary care physicians. ProMedica and St. Luke's, I believe, are moving ahead, even in light of the fact that the FTC is seeking to enjoin that transaction, but that's in Toledo, Ohio. That's been a very high-profile transaction, and the Feeney-Putney transaction down in Georgia is also a very high-profile transaction. Regulators are going to look at the impact of the transaction both on hospital service and physician service markets. In our case, why it was easier was Community Health System was not in this market. There isn't going to be a change in competitors. There wasn't a consolidation of our market because Memorial Health System was not combining with another entity already in the market. Very quickly, if the size of the transaction is big enough, the size of the parties and the size of the transaction is big enough, you may have to file. You may have to make a pre-merger filing under the Hart-Scott-Rodino Act. And an HSR filing is essentially where you tell the Federal Trade Commission about the transaction, you give them the particulars of the transaction, you give them relevant transaction documents, and you also give them what are called 4C documents. And 4C documents are documents that talk about strategies, talk about plans with respect to the hospital, et cetera. And so you have to be very, very careful if you have to file Hart-Scott that what you do is, and what you need to do is consider market concentration, consider hiring an economist to do a study. If you think that the market is going to become highly concentrated, they will do what's called an HHI analysis, and they will also do what's called a diversion analysis, where they look for next best alternatives in your market should 2 market competitors combine. Understand that payers are likely complaining parties, so you may want to consider engaging with payers and large employers to explain the benefits of the combination, because that may help diffuse some of the issues that if the FTC does come into your market and start looking at a transaction, be able to diffuse some of the concerns of payers and employers. And also, I highly recommend that if it is 2 market competitors, that you consider adopting and following antitrust protocols that are basically rules of the road on how to deal with competitively sensitive information. That helps avoid gun jumping, and it also helps avoid creating problematic 4C documents. All of this leads up to the fact that if you have to file a Hart-Scott-Rodino, if you have to make an HSR filing, you have to understand that once you make the filing, a merger can't go through until the waiting period is either expires or is closed, or if it's been extended by the FTC or by the Department of Justice, that they have then closed the investigation. So understand that antitrust is still an issue, even though it was not an issue in this particular transaction. Last couple of items that I want to run through in the last couple of minutes is due diligence and compliance. Understand that in not-for-profit to for-profit transactions, they are usually structured as asset purchases. And the reason they're usually structured as asset purchases is that not-for-profit organizations are usually held in a corporate solution. They're usually held in some sort of a tax-exempt corporate solution, a not-for-profit organization that is, in fact, tax-exempt. Most for-profit buyers, they will buy assets. One of the reasons they buy assets is a tax reason, because they want to step up in basis when they buy the assets and the ability to depreciate the business and the assets that they have purchased. And in addition, it helps them avoid, they can pick and choose the liabilities that they would like to assume, as opposed to trying to buy a corporate shell. When they do this, though, because they want to avoid cash flow problems, they oftentimes will buy receivables, and they will also buy Medicare provider numbers. That deal structure for these buyers carries with it significant successor liability. So as a seller, you should understand that these buyers are very sophisticated and they are concerned around successor liability, and they're specifically concerned around coding, billing, Stark law violations, anti-kickback risks. And the reason they are is that reimbursement type of liabilities under the anti-kickback statute, the Stark law, the False Claims Act, the Civil Monetary Penalties Act, all of those liabilities, even if they happen prior to the transaction closing, they follow those provider numbers, and they also potentially follow those receivables. So believe me that those buyers, especially companies like CHS, they will ferret out those problems. They have very large staffs that spend an awful lot of time looking through due diligence and all the way through the transaction, looking at the schedules, looking at the transaction documents. And if there's a problem there, they will find it. Very likely they will find it. That's why I highly recommend that if you are a seller or you are considering a transaction, that you undertake your own due diligence review of yourself prior to even marketing the hospital so that you can uncover any potential significant risks. And the reason I say that is, in many cases, community hospitals, smaller community hospitals, may not have an in-house general counsel and may not necessarily use outside counsel that often. And in some cases, get very, very comfortable with doing their own transactions, doing their own documents, and only calling lawyers in when there's, quote, something major going on. And because in many cases they aren't lawyers, they haven't kept up with everything. They don't realize that you couldn't do X, Y, and Z anymore, but yet they continue to do it, or they didn't realize that they had legacy transactions that violated laws that had changed. The reason this is important is several reasons. One, with entities like community health systems as well as their brethren, once they set the price is never going to go up. The only way the price can go is down. And so you want to know if there are issues that you have priced them in already. The other thing is that issues discovered late in the sales process can either slow your deal down completely, can cause your deal to change, or can kill your deal. If it slows your deal down completely, a hospital that is bereft of cash can run out of cash. If it changes your deal significantly, you may have to go back and get reapprovals of old approvals that you've already received. And the last thing you want to do is you don't want to go back to the AG and ask for permission to do a deal again. And then finally, you can have a deal unwind, which is embarrassing for everyone. So I highly recommend that you do diligence on yourself. Finally, with respect to transaction issues, you can expect with buyers here fairly robust representations and warranties, as well as robust indemnity obligations. For-profit buyers answer to public markets and answer to shareholders, and so making sure that their transaction is as tight economically as possible is going to be important for them. So they will want to know everything they can know about your hospital, and they will expect that if there is a problem that has a genesis prior to closing, that you pay for it, that the seller pays for it. There will also be certain fundamental representations and warranties that will survive for extended periods. And you can expect that indemnities in many cases, if there is not a successor organization like a foundation, in this case, in our case, we did form a foundation in Memorial in York, Pennsylvania, but if there's not such a foundation, or if the foundation refuses to stand behind the indemnities, you can expect that indemnities will be supported by escrows, that money will be put away for some period of time, generally anywhere from a year to up to 4 years, will be put away to support those indemnities. So in sum, those are kind of some of the compelling legal issues that we're seeing in these transactions. Those aren't all the issues. There are tax-exempt debt issues. There are issues dealing with consents, with licensure, with CON. There's a whole raft of legal issues that go along with these transactions. They are complex. They do take time, and they do take good counsel to ride along and help the organization in these. But I thought that these were the 4 or 5 real compelling issues that if you're thinking about a transaction, these are the issues that you should think about. We very much appreciate your attention here today. We've got about another 10 minutes or so in which we are happy to take questions from the audience. And operator, if there are any questions, I got a couple ahead of time. I'm going to ask a couple of people, but if there are any now from the audience, we're certainly happy to take them. We do have we do have a question here that we have. What impact does McCarran-Ferguson have in today's healthcare environment, and do we expect Congress to modify or repeal it as legislative support has grown? And if so, when? Matt, have you guys seen anything on McCarran-Ferguson in your dealings?
No, we've not seen it raised as an issue or anyone questioning if there's a potential change brewing on that. That's not a topic that we've seen addressed in any of the transactions we've done.
Yeah, we haven't either. It really, to be honest with you, it hasn't been raised as an issue in any transactions that I've been involved in. So this is the first time I've actually had someone ask me that question. It's a very good question, but I personally have not seen it. We did get another question, and one question was for Ken was what kind of, without giving away company secrets, Ken, what kind of pipeline do you believe that for-profit organizations like yours are going to see over the next, or what kind of pipeline do you see now and over the next, say, 18 months?
Well, I think it's been very robust. There's a lot of, and Matt can say that too, because a lot of my deal flow comes from the people like Matt's company that brings deals to to us. But we've seen a lot more people talking and considering looking at some sort of transaction, and especially in physician practices. That's been keeping me also very busy. So very active.
And Matt, do you second that? What kind of pipeline are you guys seeing?
Yeah, I mean, we're certainly seeing a lot of activity. It's safe to say that there's not one hospital provider in the country today that's not asking themselves the question about their future and whether or not they can survive on their own or whether or not they need to consider a partnership with someone. That doesn't mean that every hospital is actively searching for a partner or is contemplating a search for a partner, but we've not seen a hospital that's not internally asking the question or is not interested in finding out about the transactions that are going on in their regional area and across the country. There's a heightened level of interest in what is going on in transactions and in consolidation, and every hospital wants to at least know what's going on and how it may or may not relate to them.
All right. And then, Sally, we had one other question that came in, and someone asked, either good or bad, what has been, and I'll let you decide whether you want to do good or bad, what has been kind of the biggest surprise or the biggest difference that you weren't expecting in working with an organization that is now part of a publicly traded for-profit organization?
Well, quickly, I guess the biggest pleasant surprise was how quickly we have gotten moving on the new facility and the interest in getting that launched and moving. So I think that absolutely was a pleasant surprise, as well as Ken mentioned, bringing certain resources to bear, and he mentioned the Studer Group. And from our employees' perspective, being able to access an expert in patient satisfaction like the Studer Group that we had always dreamt of being able to access. And that's already landed here. We've already done 2 sessions with them. Has been absolutely phenomenal. I think probably if you look at it from the negative side, and it's not really a negative, it's just something that we need to get used to, is in fact the immediacy of report requirements and some of those sorts of things that, we just have to get accustomed to. And certainly it's understandable when you're looking at 130-plus facilities. You can't allow everyone to be on a different schedule and wait for things. I mean, there has to be that sense of urgency in getting data up, and it is the only way to manage. So that's something that we have to get used to.
Matt, just to play off of that, in the clients that you work with, what is probably the biggest fear that they have in looking at a for-profit partner, and how do you deal with that?
Well, I think there are actually two. One is loss of control. That certainly is number one. And number two is, what will the culture change be? And will they immediately come in, will a for-profit immediately come in and put profits ahead of culture and mission and employee satisfaction, so to speak? And a lot of that comes down to education and trying to make sure that not only the board and management, but the employees understand that whoever the partner is going to be, but particularly if it might be a for-profit, that their motives for coming in and partnering with the hospital are the same as what a not-for-profit would be, which is that provision of care and treating the employees well as the patients is the only way the organization can succeed, and that a for-profit buyer does not want to come in and pay money for an asset that's going to decline in value. And the only way for that asset to maintain its value is if the mission and operations of the hospital are continued, if not improved. And so it's an educational process to try to show the motivation for a for-profit coming in and how they're going to operate, and then also building on a track record. One of the things that we find most successful to alleviate these concerns are site visits. So if it looks like a for-profit is likely to be involved in the final decision, let alone the final choice, we will suggest that a group from the hospital that includes board, management, nursing, physician, go visit a number of facilities and be able to meet with and interview, so to speak, and just have casual conversations with a variety of employees at a for-profit hospital to get a sense of what it's really like there to help build that comfort factor.
And Sally and Ken, if I remember correctly, you all did do a site visit to a hospital that you hoped that CHS would, the type of hospital CHS would build for you. Isn't that correct?
That's correct. Actually, we visited that one and two others, and I would echo what Matt says. I mean, it is absolutely imperative to get out and touch the culture, and that was one of the selling points for us, quite frankly, is that we were able to see how these facilities were running and be able to talk to people who had gone through transition, and it really was critical to our decision. So I would absolutely think that's the best way to get to know the organization.
Terrific.
By the way, Roger, I promote that on every deal, whether Matt's, whether Kane or whoever's involved. I promote it on every deal. I let them pick where they want to go also, because I don't want to be influential, take them to the best spot I got. So that's very important to us too.
Great. Thanks, Ken. Well, I think that's it for questions. That wraps up all the questions we have. In the last couple of minutes, what I want to do is just give you all a little bit of information. I want to thank you again for sticking around. I know it's a very long, this is very long web conferences, and you've been very good, very quiet too. Anyway, the contact information for each one of us is set forth in this slide. And then I believe that we would like you to take a look and mark your calendars, because we have 3 other web conferences coming up, one in October, which will deal with affiliations between not-for-profit healthcare providers, and that will be led by 2 of my partners, Rick Seiden and Heidi Jeffrey, as well as a number of very interesting people from the capital markets, debt private placement for healthcare providers, and what my partner Laura Bilas will moderate that, and then preparing your institution for an affiliation, which sadly you may have to listen to me again in that particular talk. We do want to thank you. There's a copy of the PowerPoint presentation, and the multimedia recording is going to be on our website within 2 to 3 days. And here is how you can get to click on it. And then we ask that you take a few moments before you leave the web conference today to provide us with your feedback. We do have a survey online, and you can reach it through Zoomerang and and it's right there. But you can reach it by clicking on the URL that's above. So anyway, thank you again, everybody. We greatly appreciate it. You can now all go back to what you were doing, and we'll resume our regular programming at this time. Thank you.
Ladies and gentlemen, thank you for your participation in today's conference. This does conclude the program, and you may all disconnect. Have a great rest of the day.